Yo, welcome back, folks. Welcome to Infin Investors, the home for all new and non-investors. I'm Curtis, and today got another portfolio update for you, the weekly series, and I'm going to be talking to you about quite a few things. Actually, there's a mixed bag of stuff to discuss this week. I'm going to talk about 6 dividend payments that I've received this week, which is awesome. I'm going to talk to you about Imperial Brands and why that stock has nosedived. I'm going to talk about impeachment with Donald Trump and how that's affecting the market. I'm going to talk about Warren Buffett's investment strategy. I'm going to talk about dollar cost averaging. I'm also going to talk about top performers and top fallers within my portfolio as well. So if you want to know more, please like, please comment, please subscribe. Still on a mission to get to 2,500 subscribers, get the world of investing out to more people in a clear, simple and transparent manner. Please share the video. I've noticed recently that a lot of more of you guys are sharing the videos, which is awesome. So please continue to share the video and get the information out to more people. So let's start with the dividends. This week I received 6 dividend payments. We're going to start in chronological order. So first I received a dividend payment from Barclays. This was around £12.30. And I think that'll be it for the banking stocks, or for Barclays stock at least for this year now. I know a few more stocks I've got will pay me some dividends in November, but I think that's going to be it for Barclays. So yeah, I received that dividend, and now, you know, I'll have to decide what I do with Barclays as a whole, which I'm going to come on to a bit later. Let me just carry on. I also received a dividend from Legal & General. This was £27.41, which was awesome. I received a dividend from Aviva this week. This was for £38.57. I also received a small dividend from the S&P 500 fund. This was for £2.60. I received a dividend from Centamin. This was for £25.84. And I also received the dividend, which was late, for MSCI China, and this was for £3.3. But shout out to Oxford Mark in the community, because he's the reason why we've all received our MSCI China, because he noticed that free trade had an issue and hadn't paid it to anyone, and obviously he raised it and it now got sorted out for everyone. So big up to you, Oxford Marks. And now with all of that being said, I received £107 worth of dividends this week, which is awesome. And yeah, I mean, hopefully one day in the future I'll be talking about £100 on a week or monthly basis will just be standard procedure. But obviously we need a lot more stocks, a lot more dividend payers, a lot more monthly dividend payers and so forth in order to try and achieve that goal. But as for now, it's been a pretty good week in terms of dividends. So all of that money currently is just sitting within the account, along with the money that I sold from Chevron, and also along with the previous dividend payments that I got the week before. So there was 2 other dividend payments I got the week before, which was Lloyd's for £26.38 and Chevron for £3.57. So all of that money is just sitting in the account, and then obviously when I top up and do my next round of investing, I will allocate all of those funds into different stocks. In terms of dividends that I'm now waiting for this specific round, the only ones remaining are Trig, which will be for a small figure of £2.95, and also Imperial Brands, which will be for about £17.52. Now, look at that graph. Speaking of Imperial Brands, their shares have nosedived this week, as you can see from these 2 graphs. If any of you guys work in business analysis or corporate strategy, or maybe even marketing, you may be familiar with the term PESTLE analysis. And basically, in short, it's the 6 factors that can affect the performance of an organization. So PESTLE is an acronym. You've got P being political, E for economic, S for social, T for technological, L for legal, and E for environmental. Imperial Brands has definitely had a political issue this week, which has basically caused the nosedive. So I'm reading this from the BBC. Imperial Brands shares dive amid US vaping crackdown. Shares in Imperial Brands have dived 10%. I'm seeing obviously more here, but that's probably at the time they recorded this article. They wrote this article, sorry. After the tobacco giant warned that the crackdown on flavored e-cigarettes in the US would hit sales, the UK firm has invested heavily in vaping products, which many believe are safer than tobacco, but it warned that demand in the US had fallen sharply since Donald Trump vowed to ban flavored varieties. This guy can't stop taking money out of my pockets right now, this Trump dude. Anyway, ban flavored varieties this month. A rise in the number of wholesalers and retailers are not ordering or allowing promotion of the products it warned. That's big. That's really, really big. The Trump administration plans to pull fruit-flavored e-cigarettes from the US market unless approved by the Food and Drug Administration in an attempt to make them less attractive to young consumers. I kind of get that from an ethical standpoint if I put my moral hat on, to be honest. It follows a backlash against vaping firms such as fast-growing Juul, whose products are widely used by US teenagers. US regulators are also examining hundreds of cases of people who have fallen ill from what appears to be vaping-related lung disease, and there have been 6 deaths and 450 reported cases of lung illness across the 33 states. So that's where it gets into the ethical side of it. Now, ethically, it makes sense what's happening here, but that is the cause of the reason why Imperial Brands has basically nosedived. Now, actually, I was talking a few videos back, and I was saying that I need to start reducing my stock holdings. And one of them that I plan to reduce was actually Imperial Brands, as in get rid of. And it was in profit, but it wasn't in profit by that much. It was in profit by like 3% or something like that. So I thought, oh, you know what? I'm going to wait till it gets into profit like 5-6%, and then I'll sell. And then this happens, and then obviously now I'm sitting at, what's the overall percentage? 19.75% loss. That just shows you the swings of the market, right? So sometimes if you do have a strategy and you're thinking to sell, even if it's really 3, 4, 5%, I would just make the sale, because that might be, that might save you a lot of hassle going forward in the future. I do think it will probably recover, but it might take some time. The only other benefit to holding Imperial Brands is, as I mentioned in the 7 recession strategies video, that a lot of consumer staples, things like fast food chains, McDonald's stock, things like tobacco stocks, and obviously I would assume to Imperial Brands, even though they're focused on vaping a lot, would tend to rise in a recession just because of the climate that we will be entering in. So at the moment, I'm going to have to hold. I'm not going to lose 19%, so I'll be continuing to buy more. My next round is due. I did want to wait this week because there was a lot of negative energy in the market, but next week I'm definitely doing all of my buys, and then I'll take it from there. In terms of top performers, we've got Legal & General still leading the way. Now, obviously, it's still actually down for me, but in terms of the last time I invested, it's up 13.18%. The news I gave last week was about Tate and Lyle. One thing also to note is that a few months back, around May, I mentioned that Legal & General was selling. They were selling their general insurance business to Alliance Technology, which had a favourable impact on shares. That's happening around now. So I think there's been a little bit of an increase due to some news that that's going to be happening now as well. I think that only got really re-announced yesterday, actually. So Legal & General is still doing well. Obviously, I'm down overall, but I have no issues with this stock in the long term. That's something that I definitely want to continue holding. Another stock which is in a similar vein, but I might have to work out whether I have to have both of these stocks or whether I decide to just merge it all into one, is that Aviva is doing well. So I'm about 8% up since the last time I invested on Aviva. Obviously still down overall. And one thing that happened this week is that a person called Glyn Barker, which is one of the senior directors within the company, just bought £98,000 worth of shares in Aviva at £3.91. I have got videos that tell you guys to look out for insider trading and look out for institutional investors. Those are the two things. Now, obviously, in this context, we're talking about insider trading. But anybody that's senior within an organization that's dumping a lot of money into the company probably has some foresight or some knowledge or some alignment in terms of what is going to go on with that company. And so I think, it's definitely worth taking advantage of that. And you can find that information out. It's public. It's all public. But I use Simply Wall Street, and that information is there in Simply Wall Street. Also, institutional investor holdings do let you know that, if companies and funds, etc., are investing into a specific stock, it does give you an inclination that, with all of their analysis and all of their techniques and all of their expertise, they are seeing some value within a stock. If I see a stock that's predominantly owned by retail investors and not that many in terms of an institutional investor, doesn't mean that it's a bad stock, but I will probably have a little bit of a cause for concern. So those are two things to definitely consider going forward. The other thing to show you guys, if we move over to the basic side, is that my REITs have been doing really well. This is what the graph has looked like over the last 7 days, and as you can see, Landsec is 10.67% up and British Land is 14.12% up. Someone in the comments last week said that they'd recommend only putting £1,000 into a stock as a minimum, just because if I get say 14% on £1,000, then obviously that's £140. It's more of a meaningful sum. Listen, I get that. I understand that sentiment, but I do have some thoughts that I think, for a lot of new investors, dumping £1,000 here and there to different stocks, I don't think is I think is pretty risky, to be fair. And I think whether you have it or not, I think the art is to learn your craft, and then obviously work on the percentages. So even if you're putting 5 or 10 or 15 pounds into a stock, but you're up say 15% on that stock, that just shows you that you are building your confidence, you are building your ability to select good stocks. So I think for me, focus on the percentages more and don't focus necessarily on the value. However, where I do agree with this guy's comment is that, or girl's comment, is that when it does come to say growth stocks, which I will be getting more into the future, dollar cost averaging growth stocks makes no sense to me personally. They wildly swing, and obviously I'm trying to just get a good performance straight away. We saw that when I bought First Solar originally, it went up like 25% within 2 weeks. That for me, if I put £1,000 in, obviously that's £250, then I could have just sold and made £250 and just left it there. Now I'm still continuing to dollar cost average First Solar, and I don't really see the benefit at the moment. So there are going to be some instances actually where, just dumping £1,000 or more into a stock, leaving it for a set period of time, realizing the growth, and then making your sale might be the best investment strategy. So it's all about taking things on a case-by-case basis. But this is why I tell you guys, you do need to start considering your investment strategies, because that will really, really help you make the right decisions. And if you are making wrong decisions, you know where you need to change and you know where you need to fix. So let's go back. Overall, I'm down 2.79% since the last round of investing, but as I mentioned, there is an investing round next week. One thing to still note is that I'm still selling shares. So obviously, as you guys saw, I sold Chevron, which I talked about last week. I've got more shares that I need to sell. I've got about 23 stocks. I personally think that's too much. That's just my personal view. It doesn't mean that it is too much. There are some schools of thought that you need 30 stocks or 40 stocks or 60 stocks. Me personally, I don't believe in getting 60 stocks. I don't believe you can make 60 great investment choices. The reason why you're getting 60 stocks is because you're actually that unconfident. In my opinion, you're that unconfident with your investment choices that you need to get all of this other stuff to potentially balance out the risk. Really and truly, I'd rather take more time in selecting the right stocks. Now, every time I bought stocks, I genuinely thought I was buying the right things. And I still think a lot of my stocks are okay, actually. But it's just too much to manage. And I think there is some duplication. Now, duplication is, and what I mean by that is, like, for example, the fact that I've got 3 banks being like Lloyds, Barclays, and CYBG. Now, duplication isn't necessarily a bad thing. I wanted to talk to you about Warren Buffett's holdings at the moment. Like, if you look at Warren Buffett's top holdings with Berkshire Hathaway, 4 of the top 10 are banks. He holds US Bancorp, he holds Bank of New York Mellon. Let me see if they actually are on free trade, his holdings. US Bancorp. Okay, Bancorp isn't, but he also owns, I can't even spell, Bank of America he owns, Wells Fargo he owns, and he owns Bank of New York Mellon. So those are the 4 stocks that he currently holds as well. And sometimes if you have a lane and you know that lane and you understand that lane, then sometimes you might just need to stay in your lane. Like, there's nothing wrong with doing that. So again, it all goes down to strategy. A lot of the time you have people telling you don't do this or do this. I think I would say probably in 30 to 40% of instances there are some absolute don't do's and do-dos, but I do think in the majority of times it's about strategy and it's about your goal and personally what you're trying to achieve. And it's really important to stick to your style and stick to your strategy. If you are a dividend investor, then a lot of this won't even matter. If you are focused on growth stocks, then actually you might take a whole different strategy than dollar cost averaging or picking certain stocks or even worrying about diversification or all of those other factors. So it's really about understanding your strategy, what you're trying to gain from it, and working it out from there. That's my portfolio update for this week. Next week there's definitely going to be a lot more information in terms of all of the purchases that I make. I might even make some new buys as well, so I will keep you posted if I do that. But other than that, if there's any questions, obviously put that into the comments. I'll get back to you as soon as I possibly can. And yeah, it'll be good chatting with you guys. Other than that, take care, have a good weekend, and last but not least, happy investing. Peace.